Let's connect with VS Mani, who's Executive Director and Global Chief Financial Officer at Glenmark Pharmaceuticals, to discuss their quarterly performance gone by. Thank you so much for taking time out. Now, to begin with, your US business has seen a good jump on a sequential as well as on a year-on-year basis. What is the outlook in terms of pricing pressure on the base portfolio, and what kind of growth do you envisage for your US business?
Good morning, everybody. Thank you for inviting me to your channel. So our US business has done quite well in the last 2 quarters. We've seen a turnover in excess of about 100 million. Last quarter, we did about 104 million. And these are all, we had a number of good launches in the US. We also filed a number of almost 8 products, and we also have had approvals of almost 10. So I think based on these, we see a reasonable growth, at least a mid-single digit kind of growth. In terms of the pricing pressure, obviously the US market, the pricing pressures are always there, and we are looking, we've seen about a mid-single digit kind of a pricing pressure, little lower than in the past quarters. But all in all, we feel there is a decent momentum in the US business, and going forward, we see it doing better.
Okay, so what is the outlook then, given this optimistic outlook in terms of your EBITDA margins? Can it cross that 19% mark versus what we saw, last year at about 18%? And what will be the drivers that will push your margins?
Yeah, sure. So first and foremost, at the outset, the Q4 was a decent quarter in terms of our sales growth. We did about 3,370 crores and our almost 11.7% growth, and an EBITDA margin of almost 17.9% at 605. I think the coming year we are quite optimistic about touching about a 19 to 20% based on a couple of things. One obviously is we expect the revenue to grow at about 10 to 11%. So that's key momentum. Secondly, we are also looking at pruning down our R&D cost a little more, so bringing it down to around 8.5%. Besides, also working on improving our gross margins also, because some of the cross pressures are a little lower, as well as obviously working on our cost side. So all this together with a decent growth in revenue should ensure that we should be closer to the 19 to 20% that we have guided the street.
Sure. Mr. Mani, also wanted to understand, because, time and time again that we've spoken with you, you've always said that the focus is on reducing debt levels. By what amount can we see this coming down in FY24? And what plans regarding getting net debt free?
So we had given a plan that we should be net debt free in about 26, 3 years from today. So obviously, with the robust growth that we are planning, 10 to 11%, and last quarter was obviously vindicated what we are thinking. So looking at the robust growth, and also on the back of the fact that we had some remediation costs, etc. last year, those should be behind us, as well as looking at our innovations at Ichnos, where we have been pruning some costs, and also looking at partnership, etc. Taking all these into together, and with a good growth that we are looking at, and some of our products doing well, I think we should be in a position to kind of looking at a zero net debt by 26. Today we are having a net debt of about 2,900 odd crores. I think with the EBITDA which we had current year of almost 2,300, a little more than one time, I think 3 years is a good time to look at a zero net debt.
Sure. What's been the reason for the sharp increase that you've seen in both inventory as well as debtor days? And this is both sequentially as well as on a year-on-year comparable basis?
So obviously, inventory last year was a little up, as well as in the current year. As you know, across the chain, there have always been some challenges over the last 1.5 years because of the inventory situation. You had various reasons as to why. The reason was that going forward, the supply chain looks at more of safety than to look at just the efficiency. So obviously, we need to have proper inventory so that we can service the market. So that is one reason why the inventories have gone up. So they've gone up about 8-9 days. I think we broadly will be here. As far as a debtor goes, obviously this year, or especially in the second half, there has been a sharp rise, because the growth has come more in the markets where there are where the credit periods are high. So in markets like rest of the world, EU, etc., they've been higher. India has been a little lower, and also currency also had a play in that. Because of the restatement of debtors. So I think going forward in the coming couple of quarters, we see it come off. at least by 10 to 15 days. So we should be closer to 100 days. And this is primarily one of the reasons why there was a little sharp uptick in our debt as well in the last quarter. I think in the next couple of quarters, we see it kind of being more receding down.
All right, moving away from the numbers, what's the reason behind registering a new subsidiary, Glenmark Healthcare? What is your plan over here?
Yeah, sure. See, as I just alluded to the fact that we are looking at a robust growth of about 10 to 11%, we'll obviously need capacities. So we are, evaluating an option of putting a manufacturing company. So that is why we are looking at a 100% subsidiary below Glenmark Pharmaceuticals. So we have registered the subsidiary. We will evaluate and decide whether we go forward or what we plan.
Okay, fair enough. But what kind of growth potential are you looking at? What is the game plan for the long haul here for Glenmark Health?
So we are looking at least a 10 to 11% growth over the next couple of years. And we obviously every year we work on a long range plan. So looking at the way if you look at it, the way we've been growing in our key therapy areas, whether it is respiratory or dermatology or oncology or some of the, like cardio, etc. So across the board, we've been doing quite well. So I think taking that, we feel that we will definitely need more capacities, and whether we put it in the existing sites or we look at a new company to do that is something we evaluate. But end of the day, I think as you can see that we are at about 13,000. So at a 10% growth, we should be doing well over the next few years. So that's the reason why we want to put up, we are looking at capacities.
Just one very quickly question, Mr. Mani, and if you can clarify on that, because I see that the India business has seen a decline on a sequential basis. What is the growth that you're targeting for this fiscal for your India business in particular?
Okay, let me respond to this in two ways. One is obviously, if you look at IQVIA MAT, even March 23, we've been growing at about 12.3%, and we expect to grow at about 13% odd in the coming year as well. So I think as far as the base business goes, the RX we are doing quite well. I don't see any, sort of any concerns there. It's just that, when compared to year, if you look at it, we obviously divested some non-core brands. We also had the impact of NLEM like everybody else in the industry. And obviously also the fact that, we also have been looking at some of our hospital and oncology products where we could prune down a bit. So taking all this into concern, that is the reason why it looks like a lower growth. But I think the underlying business is doing quite well. And also, just to add, we also had during the year, we had some COVID product sales returns also. So that is behind us. So I think these, extraordinary items should be not there. So therefore, I think the underlying growth should be decent.
Okay, good to hear that, Mr. Mani. Great to have you today on ET Now. Thank you so much for taking the time out and speaking with us today.
Thank you very much. Thank you.
Okay, that's the word coming in from Glenmark Pharma. Let's just quickly bring up the stock price up for you, holding solid by a good 1% as we speak right now.